Hey folks, Dan Frio here, your trusted mortgage advisor, trying to make sense of this market for you guys. Well, did you realize the Federal Reserve is meeting next week? So what we're going to go over next is the projection or predictions that I have on what they might do, because there's rumblings that throughout the whole market, are they going to raise rates 0.75%? Are they going to raise them 1 full percent? What data did they look at? And we're going to explain all that next. So if you're new to the channel, all I ask you to do is give us a thumbs up, subscribe down below, hit the bell every time we post a video, you get an alert. So let's get to it. We know that the Federal Reserve is trying to cool off the economy. And when they look at a lot of indicators to help them analyze that data to figure out, okay, do we need to continue to raise rates or raise rates even more to basically subdue the economy? Well, let's get over to some of the news that was just published today that might be seeing that the markets are doing the job for the Federal Reserve. So let's get over to the news. The first thing I like to look at every day is the economic calendar. What is taking place today, or maybe even tomorrow, that the Federal Reserve might be looking at to say, the economy is still cooking on all 4 cylinders, or it's starting to cool. So let's just look at 2 indicators today, and there's really nothing out tomorrow, so this should be basically the news out for the rest of the week that will play maybe some havoc on the market or maybe not. But we have 2 indicators here: initial jobless claims and the Philly Fed's manufacturing numbers. So let's break down these 2 indicators. The first thing we want to go over is to the jobs market. Jobless claims rise again in another sign that the labor market's cooling. So we're starting to see the labor market starting to cool off. Initial claims totaled 251,000 from the week ending July 16th, up 7,000 from the previous week, and higher than expectations. The analysts thought there was going to be 240,000. Here's a release so you guys don't think I'm lying to you. This is right from the unemployment agencies, from the government. You can see right here, we bottomed out basically in April, and we've had an uptick ever since. So that's telling me, okay, the job market is starting to cool off. So that's one piece of this puzzle. Let's go back to the economic calendar. So we see here, again, the last reading was 244,000. The Fed thought that there was going to be reduced. So the number of people filing for first-time claims was going to go down. It actually went up. And it went up about 11,000 more than they expected. But the next piece of this puzzle is the manufacturing index that they look at. And it was weak last month. It came in at a negative 3.3. Anything below 0 means the manufacturing industry is contracting. The forecast was for 2.5 negative. It came in about 5 times that amount, down 12.3. So let's get over to that piece of the puzzle. Philly Fed district factory activity contracted again in July. Business activity among manufacturers in Philadelphia area contracted July for the 2nd consecutive month, while supply shortages and inflation pressures continued to ease. The index suggests that the regional factory activities declined at its steepest pace than the previous months. So that's what we see so far in the economic news and that calendar. So why are these 2 numbers that are posted today, just days before the Federal Reserve meeting, that important? Well, let's look at it. The Federal Reserve has 2 mandates. 1 is full employment, and 2 is to keep inflation in check, or price stability. Okay, so we see in the report that 1, jobs are starting to get lost. Okay, why? Well, we see it already in the initial jobless claims. Those numbers are moving up. And then we're also seeing it on the manufacturing level, where their production is dramatically down reading after reading. So what do they do, or what do they have to do if the production is way down? Well, they have to start laying off people. So that's going to create more unemployment. Okay, this is all in the wheelhouse of what the Federal Reserve is trying to do. They're trying to basically cool off the economy. Unfortunately, when this happens in a recession, what normally happens is increased job unemployment. Okay, manufacturing goes down, because that means we have negative GDP, and that's what we've seen over the last 2 quarters. So that means that the recession's here. So when we look in the rearview mirror 6 months from now, they are going to say, yes, we were in a recession. And a lot of these pieces are starting to pull together as we speak. So now, based on this information, what is today's rates and what's my projection for next week? So let's get over to where rates are so I can give you my input there. So for me to see what's going on with mortgage rates today, basically live, I log into the MBS market. It's the mortgage-backed security market. That's the bond that trades on Wall Street. That's yield. The yield on that bond is the biggest component of your mortgage rate. Okay, so this chart right here gives me what's going on to the price of that bond, and it's right here. All right, the easiest way for me to explain this is when this number is going up, that's great news, because if this number goes up, mortgage rates come down. As you can see from the chart down below, we've had a lot of red and we've had a lot of down, but down at the bottom right down there, you can see, did we hit another short-term bottom, or could it be a longer-term turn in the markets? Time will only tell. So now a look at rates. These are mortgage rates published by Mortgage News Daily. This is not a single lender's rate sheet. These are not my rates. These are just the national averages out there. And I use the Mortgage News Daily because it's just an easy format to read. You can see there's 6 cells, 6 rates, and it gives you the difference from where they were yesterday. And then it also gives you a 52-week range or a yearly range. Here's what's nuts. Look down here where the 30-year fixed was. The 52-week low, or the 1-year low on a 30-year fixed rate, was 2.78. It's double. It's doubled. And this rate was basically there at the beginning of the year. So rates have doubled since that. We are coming off the high. You can see that we're about 0.5% down from the high, so that's good news. And the nice thing is there's really not much activities in the market. You can see we're used to seeing over the last 3 to 6 months these numbers dramatically moving on a daily basis. It wasn't odd to see mortgage rates move 0.25% maybe in one day. So the markets are starting to stabilize a little bit. So let's put some of this into context. The Federal Reserve is doing everything they can to cool the market. They're not really trying to crash your house's value, but they're starting to try, or they're working on stabilizing the housing market, because that's one huge piece of our inflation index. Okay, so they did a miserable job, but they're starting to do a pretty good job, but the markets are starting to do their work for them. What do I mean by the markets? Well, when the Federal Reserve comes out and says, we're going to start jacking up rates higher and higher and higher, do anything we need to do to cool off this inflation, a lot of companies and a lot of people start thinking, oh boy, I better start doing something on my own to basically prepare for all of this. So you might stop spending more money on furniture. You might stop putting so much gas. You might stop traveling. You might stop going out to dinner. All that is going to make the economy contract. Well, when the economy contracts, you have job losses. Okay, so this is all what the Federal Reserve is trying to do. It's not to crash your home. It's not to drive unemployment out the roof. It's basically to calm down the system. So now for my game plan on what I think the Federal Reserve is going to do next week. They're going to come out in and increase the federal funds rate 75 basis points, just like they told us to. But now, what are they going to give us as future guidance? So they should be saying this. We're starting to see inflation peak out. And there's only one number that's coming out next week that's going to be before they actually come out with their decision, okay? But they're going to look at the unemployment numbers like we're seeing today and saying, the job market's starting to cool off. They're going to look at the manufacturing numbers, saying manufacturing is falling off a cliff. So maybe we don't have to be as robust as we think we need to be because the markets are starting to cool. And you got to remember, guys, this is a barge. This is a huge cruise ship, say. It's not a little speedboat that you make one little adjustment and the whole thing adjusts. You have to make tiny adjustments and let its way to work in the system. So if they go too aggressive, like a lot of people are saying, now that's going to put a shock and awe in the system. So then 6 months from now, they have to start easing. Well, why would you do that? Why would you basically hiccup the system right now to only start easing 6 months from now? So if they're smart with all this, they come back and say, they do what they said they're going to do, but their future guidance is going to be more of a dictation of this. We're starting to see the economy starting to cool off. You're seeing that in the jobs numbers and the manufacturing numbers. Those are two of the biggest pieces of this economy. So based on that information, we'll give you further guidance saying, yes, we're going to do everything we need to do to curtail inflation, but we're going to raise rates on our next meeting 50 to 75 basis points. I don't think either one really matters, but we need them to come out and say exactly what they think they're going to do. If they go anything higher than 75 basis points, it's going to be a shock in the system. If they say 75 to 50 basis points, you're going to see a nice little rally in stocks, and you're going to see a nice little reprieve maybe in mortgage rates. So that's my prediction of what the Fed might be doing next week. So I hope you like my videos. If you find value in this, all I ask you to do is please give us a thumbs up. And if you want to find more about me and my team, all you have to do is go to therateupdate.com. It's right here. You can apply, you can call us, you can schedule a meeting, and you can even chat with us if you have anything. So my name is Dan Frio. I do the Mortgage Minute every day to inform you guys everything real estate, especially in the financing piece of this puzzle. I hope to be your mortgage advisor if you're in need of a mortgage, if you're looking to build, buy, refinance, reverse mortgages, or anything. So thanks for watching. God bless. Have a great day.